So here's AI. Let's do a quick investing in AI thing. There's 5 layers at which you can invest in AI. Layer 1 is the chips. Layer 2 is the data centers. So all my friends who built like the big tech companies, they all data center investing, right? And there's tons of money going to that. Level 3 is the actual AI model companies. This is like OpenAI, Anthropic, and Elon's XAI, right? I'm invested in. Level 4 is infrastructure for AI. This is how you deploy AI. It's stuff like Olama, which engineers, millions use per month to deploy open source AI stuff. Lots of stuff there. Palantir is kind of level 4 if you want to think about it that way. And level 5 is the AI services companies actually performing the service in the economy, right? So you have these 5 levels of like AI companies. And venture, of course, you could do some level 3. There's only 3 or 4 of these companies that are the actually, OpenAI itself and XAI itself. But most of what we're doing is level 4 and 5. Now, the big argument in venture is level 4 going to be eaten by level 3? Are the model companies themselves going to build out the infrastructure and own it? So how do you think about that? But then the biggest area is this level 5 thing. The level 5 is about building things in the service economy. So for example, just to make it clear, healthcare billing is a $280 billion a year revenue industry in the US, massive services industry. 120 billion of that's actually paid to companies, 160 of it's internal spend, but massive example of an industry, right? Out of the 5 trillion, it's I know it's like 5% of the whole services economy. And like that's something where we're making it already 3 times more productive, 3 times higher margins versus like thousands of companies using AI, right? So and it takes like years to build it out, to get it right, to deliver. It's not just, it has a moat.
You have to have a framework. I mean, basically you can imagine having 2 agents, one for insurance, one for the hospital. You need to have a framework. How do we negotiate on billing? What are the codes?
Yeah, so there's all, you same way as any other company, you need a big team, you need to iterate, you need to do it. And so, the venture capital firms that are going to be crushing it, sure, some might be exposed to a couple of model companies, whatever, but most of it's going to be level 4 and 5. And you have to be in the best firms tied to the best engineers to access that, because there's going to be trillions of dollars.
So how much money is going to be lost investing in the losers?
Well, it's always the nature of these things, is like how much stupid money does a sector attract. And I think this one's going to have, and the bigger a sector is in the returns, the bigger the stupid money it attracts as well.
So, right? So you're saying the most well-known companies to the average person, like everyone's aware of like Anthropic and the Claude model. You're saying like that might not be the layer to which most of the gains accrue.
I don't think it's the layer that 10x is from here, or maybe
from
10x
here,
is,
because they're already very valuable. OpenAI is already very valuable.
And it's unclear, but basically, for example, when you invest in the SaaS wave for the last 15 years, the layers people knew about, which might be like AWS cloud, that probably did capture maybe 25, 30% of all the value, which was a great investment. So there probably are some great investments just in the infrastructure layer everyone knows. But I think by far the best risk reward is the really great companies on top of it that you can back early and that grow into companies worth tens of billions.
Which is Salesforce or even younger companies.
Well, I'm thinking for the AI wave, of course, younger companies. So the SaaS wave, Salesforce would have been great to get into right at the beginning.
That's what
yeah, that was great. Right at the beginning.
What's the so the corollary to that is not necessarily the OpenAIs. It's
the corollary to that, to say Salesforce would be like things you don't know about yet, like Cognition or like Bedrock, or these companies that are doing AI services on top, and they're the best talent in the world for different parts of coding or different parts of construction using AI, or different parts of healthcare billing with Candid, things like that, which you guys don't know, no one's heard about yet unless you're kind of in the middle of the sector.
So do you guys think that this is going to expand margins for all companies? Like, are we going to go from 18 to 23%?
This is a great question. I actually do think that the whole society does benefit as well. So I think like the market itself, there's a big macro question about where the heck things go the next few years, and that's a separate thing. But over the next 10 years, every Fortune 500 company should benefit. If you look at what Dell's doing, for example, using AI, they've already removed billions of dollars a year of expenses. He's probably ahead of everyone else, but all the big companies are eventually going to do that. It is going to expand margins.
AI isn't just about breakthrough models. It's about a layered ecosystem. Imagine it like a pyramid. At the base are the hardware and data centers that power AI. In the middle are the companies building AI models and the infrastructure to deploy them. And at the top are the services transforming entire industries. Today we'll look at all these levels and what they mean for investors. At the base, we have the chips, advanced semiconductors like GPUs and TPUs that provide the raw computing power. Without these, training modern AI systems wouldn't be possible. Major players like NVIDIA and AMD are at the forefront here, innovating rapidly. While chip investments offer broad exposure to multiple tech sectors, they also face high competition and evolving technology standards. Next are the data centers. These massive facilities host the servers and infrastructure needed to run AI applications. Think of tech giants like Amazon Web Services, Google Cloud, and Microsoft Azure. They invest billions in maintaining efficient, scalable, and reliable data centers. While these investments may not get the headlines, they're crucial for the entire AI ecosystem's functioning and have relatively stable long-term returns. Then there's the exciting layer of AI model companies. These are the innovators behind the algorithms and architectures that drive AI. With big names like OpenAI and xAI in this space, they capture the imagination with groundbreaking research. However, because there are only a few true model companies and they already command high valuations, the risk-reward ratio might be less dramatic compared to earlier stage investments. The fourth layer deals with AI infrastructure, the tools and platforms that deploy these models at scale. This includes everything from middleware frameworks to deployment platforms used by startups and established players like Palantir. A major debate in venture circles is whether model companies will eventually build their own deployment tools, potentially encroaching on this space. Nonetheless, this layer presents fertile ground for both nimble startups and larger-scale innovations with significant growth potential. Finally, we reach the apex, AI services. These companies integrate AI into everyday business operations, transforming industries from healthcare billing to finance. For instance, the U.S. healthcare billing industry is a multi-billion-dollar space ripe for disruption. By automating processes and reducing inefficiencies, AI services can boost productivity and margins significantly. Here, companies could achieve explosive growth, though the challenges of scaling and integration are non-trivial. So how much money might be lost on the losers, and where does the best risk-reward lie? Just like in previous waves such as SaaS, chasing hype comes with its share of risk. While the AI model companies are transformative, their high valuations suggest that the most explosive returns might be found further down the pyramid, in the infrastructure and services layers. These areas might yield the hidden gems that could scale from modest startups into industry giants, much like early investments in companies like AWS during the SaaS boom. The key is diversification. Investors should not only chase the big names, but also stay attuned to innovative startups that are perfecting the deployment and service aspects of AI. It's all about balancing high-profile bets with smart exposure to emerging opportunities that have the potential to redefine industries. Beyond individual investments, the AI revolution stands to benefit society as a whole. With AI-driven improvements, even traditional Fortune 500 companies could see margins rise from, say, 18% to 23% or more by cutting costs and optimizing operations. In many ways, AI is not just a tech upgrade. It's a systemic change that can unlock trillions in economic value over the next decade. For investors, this means that regardless of where you allocate capital within the AI space, you're tapping into one of the most transformative trends of our time. While all layers contribute to the overall AI ecosystem, many believe the real potential for explosive returns lies in the infrastructure and services layers, areas ripe with innovation and market disruption. If you enjoyed this deep dive into AI investing, don't forget to like, subscribe, and leave your comments below on which layer intrigues you the most. Thanks for watching, and stay tuned for more insights on the future of technology and investing.